Hey everyone, welcome to Monetary Minds, the podcast where we dive deep into the crucial questions and challenges facing central banks and the global economy today. I'm your host, Joeri Schasfoort, ex-economics lecturer and founder of the online economics outlet Money and Macro Media. Today we're exploring the monetary consequences of Trump's trade war against its staunchest allies, Canada and the UK, which is quite weird. That is, the US current account with both Canada and the UK often is seen as relatively small and unproblematic, and on top of that, Canada and the UK tend to run trade deficits rather than surpluses in the global system. So why go after them? It makes very little sense. But it's happening anyway, and Canada has retaliated while the UK so far has not. This trade war is a huge headache for the Fed, Bank of England, as well as Canadian central bankers, who may expect slower economic growth and increased inflation. So, how should they respond? Raise rates, lower them, or something else entirely? Joining me to shed a light on this important topic are Jared Laxton, an economist at Advanced Macro Policy Modeling, along with Koko Ohanian and Hayk Kalantaryan, who are both macroeconomists at the Central Bank of Armenia. Importantly, all of them are trained using the Central Bank Forecasting and Policy Analysis System, FPOS Mark II, which is a state-of-the-art framework that uses scenario analysis rather than baseline forecasting to analyze the uncertain global economy that central bankers face today. So, today we'll be talking about three scenarios for each of these economies. A scenario A, which is a scenario in which interest rates will need to be higher than the market expects to contain inflation. Scenario B, a dovish scenario in which they'll need to be lower. And finally, a scenario X or Y, which is an extreme scenario, such as a crisis. Okay, let's start with the US, where the trade war is also starting. Jared, you have studied the situation in the US. The Fed faces expansionary fiscal policy thanks to massive tax cuts, and at the same time a stagflationary threat to its economy from tariffs. Can you maybe tell us a little bit about the scenarios that they are facing?
Yep. So maybe to start off answering that question, to talk a little bit about the Fed meeting that just happened the other day, right?
Yep.
So the Fed just had the meeting yesterday where they decided to leave interest rates where they are. And in many respects, the decision itself is probably one of the least interesting elements that come out of these FOMC meetings. Typically, what people are most interested in is what Powell usually has to say at the press conference, where they're trying to push him into telling them a little bit about something forward-looking. And in the situation that we have today, where there's a lot of uncertainty, like you said, the U.S. economy, one can easily imagine the U.S. economy moving in very different directions. And one of the implications that we kind of can already see from the Fed projections that they released yesterday regarding the tariff policies. So they revised their economic projections, and the Fed both at the same time reduced real growth and increased their inflation projections, the baseline. But even on top of that, if you look into the later pages, the distribution of risks have also skewed towards lower growth and higher inflation, based on the views of the board at the Fed. And so there you can already start to see how people are viewing the implications of the trade war. But probably most interesting is the fact that the interest rate projection was unchanged. Okay, so we're getting this kind of divergence between growth and inflation, and it's leading to a fairly predictable behavior of central banks whenever those types of stagflationary shocks happen. Is it tends to paralyze monetary policy. And so that's kind of what we're starting to see at the moment. At some point, like you said, we'll probably have to move into either a more hawkish scenario or more dovish scenario, depending on how the economy develops over time.
That's very interesting. Yeah, do you know actually? This is very interesting. You mentioned like the stagflationary threat tends to paralyze central banks. What should they do, or is there anything that they can do? Like, or is this something that they really need fiscal policy or something else to come in?
So it essentially depends on how you view the economy today. And I mentioned, we could go in very different directions based on, the different, because there are very big vulnerabilities in the economy right now. If we were in a very strong position, in the sense that, the economy was at a roughly stable position, meaning, okay, we're experiencing high but sustainable levels of growth, inflation is on target, then, you may want to, under the case of this tariff that was stagflationary, that will lead to a price level increase, but also, reduced output. Then this is something that the central bank may strategically want to look through. Therefore, them not raising rates or lowering rates would actually be what they're trying to do, because they're just ignoring it for the time being. That would be the strategy.
And that's a good strategy then, is what you're saying.
That perhaps is the optimal strategy that you want to have. Yeah.
Because it's just so uncertain.
Yeah, that it's it's not uncertain the impact. Like you think, that inflation is going to rise, or sorry, the price level is going to rise, and it will be a one-off on inflation. But the economy is anchored, and therefore you don't need to respond with higher interest rates to even further deepen the reduction in demand and the negative consequences on the real economy from the tariffs.
Yeah.
But you have still other things that you need to think about, which is where the uncertainty plays into it, where you may have to raise interest rates, or you may have to decrease interest rates based on certain critical developments in the economy, either from an inflation perspective, which would mean, let's say the tariffs, let's say that inflation is not perfectly anchored to the target when these tariffs occur, which is a fairly plausible view to have these days, given the fact that inflation remains well above target, or at least 1 percentage point above the target, which is, like, in and of itself not really large, but the fact that it comes from a shock that happened essentially 3 years ago, when oil prices rose in 2022, and the fact that we're still seeing high levels of inflation is indicative that there might be an inflation premium in the economy, and we shouldn't be so confident that inflation is anchored, and therefore another inflationary impulse from these tariffs could feed quickly into the economy, in the sense that both wage, and you'll see it reflected in both wage and price inflation, outside of the categories directly affected by the tariff, in which case we would need to raise interest rates in that type of scenario. So that would be your more hawkish scenario.
So is then this tariff scenario sort of comparable to the COVID lockdowns, supply chain disruption scenario, where it's like it's in theory a one-off thing, but it's maybe so massive that it will lead to higher inflation anyway, because it leads to higher inflation expectations?
Yeah, so COVID was a series of stagflationary shocks, right?
Mm-hmm.
If it was just one of them, then maybe inflation wouldn't have taken off at the end of the day. But it was a combination of the lockdown policies, and then after that, we had the increase in oil prices, which was another major shock on top of it, and also food prices, which occurred after the Ukraine-Russian conflict. So these were kind of two really large shocks, stagflationary shocks that happened consecutively. And this is what probably really led to the more persistent inflationary impact on the economy. And now we are basically faced with another one. So when the economy still hasn't fully recovered from the previous ones. So that's why it could just be a continuation of that process.
And could this also be another set of shocks rather than just one? I mean, after all, like Trump may start with tariffs, but then there's retaliation and Trump retaliates again and so forth.
Yeah, so that's probably connected to a more, actually not inflationary scenario, but deflationary scenario. Because if these trade wars kick off, if these tariffs kick off a full-blown trade war, then the market so far has been pretty keen to adjust their expectations for growth under such a scenario.
Do you mean stock markets are down, is what you're saying?
Yeah, stock markets are already down by nearly 10%, just based on the tariffs that have been implemented so far. And this could be the catalyst for a worsening, domestic demand scenario that would ultimately be disinflationary or deflationary, where you would actually need a lower interest rates response in such a scenario.
So okay, now you have your scenario A. You have more inflation because of the tariff hike, and then this feeds into the fact that inflation is already too high, and you get inflation expectations to go out of control or de-anchored. But it can also be that this trade war tanks the stock market, which comes to a financial, well, not yet crash, I guess, but which then leads people to buy less stuff in the economy, and then this leads to a deflationary sort of impulse that may be bigger than the inflationary threat from the tariffs alone.
Yeah, exactly. I mean, we've been doing, so to get a sense of this case B, or this kind of dovish scenario, if you look at what equity prices have been doing during the pandemic, they've just skyrocketed over this period. It's something to the amount of households adding about $4 trillion worth of wealth every quarter on average during that time. And so we've been doing some work that this has clearly impacted the consumption function among households, where it's not only had a direct effect, you can think of a more direct effect, but also it's made households think that they don't need to save as much. So savings rate under this time has been very low. Mm-hmm. And so the idea would be that with this correction in equity prices, and which is hurting household wealth, that households may start to become concerned about this situation, and their savings rates might rise, and therefore consumption would slow down under that scenario. And that's why we would see a more significant decline in the real economy, and that's why interest rates would have to come down eventually.
Yeah. And how do the tax cuts feed into all of this?
So the tax cuts are another potential wrench into the Fed trying to achieve its mandate, in the sense that the tax cuts are not exactly what you would want for a government that already has high levels of debt, and then on top of that, have high levels of deficits as well, which we are bringing over from the pandemic and still haven't really fully consolidated. So we're essentially running kind of wartime deficits in peacetime. So the deficit to GDP at the moment is around 6%, which on its own is already suggestive that it could lead to debt sustainability concerns. And that's why the tax cuts that are being proposed have the potential to exacerbate that, the position of fiscal even worse, and make debt sustainability even more unsustainable. So that's a pretty big issue as well.
But is that then a hawkish or a dovish scenario? Because, or does it add to the probability of a hawkish or dovish scenario?
So all of these, like the first way to think about them, they're all pretty hawkish. So tariffs should be hawkish. Fiscal deficits should be hawkish. The Fed should respond with higher interest rates under those scenarios. But there's always the case that when these things become unsustainable, so when the tariffs lead to a correction in equity prices, this changes the calculus of what the Fed should do. If markets realize that the tax cuts would lead to debt sustainability issues, then the 10-year is already going to increase quite a bit, because there's risks that the U.S. government won't pay the debts off.
Yeah.
And so that can quickly turn what would typically be associated with a higher interest rate scenario with a lower interest rate scenario as well.
Okay, so, all right, I do want to talk also with you about an extreme scenario where we truly get a crisis, but before going into that, I think it makes sense to go across the border to Canada. Koko, you've been studying Canada. What do your case A and case B scenarios look like for Canada, for the Bank of Canada in particular?
Sure. Let's just quickly give an overview of where the economy stands today, because that way it would be easier for the listeners to picture case A's and case B's. So the Canadian economy was growing, but it was fragile. So not a lot of confidence in the Canadian economy by both consumers and investors, where we were not seeing business investments. Consumption was not picking up. Only after these recent cut, we started seeing some consumption, domestic consumption picking up. It was mainly held up and avoided recession because of the robust economic growth south of the border in the United States. And that way they exported a lot of stuff to the United States, and that was the main thing there. Plus, a lot of immigrants going into Canada. So population growth was really high in Canada at the time. So it really held the Canadian economy up. And the main points are the risks and uncertainties that can take us away from a baseline scenario, let's call it that, or what the market expects into case A's and case B's, are mainly have to do with tariffs, interest rates in the US, so it's very US centric, but also the housing market in Canada itself. So those are the main things that can take it into different directions.
And what are market expectations right now for interest rates, or what are interest rates at, and what are market expectations? Like, what's the baseline?
So that's a really good question, because if you look at their forecast, it's a baseline forecast for things to stay the same virtually, whatever they are now. If you look at their forecast a year ahead, you don't see much difference from where they are now today. So really, I mean, some of the things that we're talking about today, they're not tail risks. Some of the stuff are described as tail risks in their reports, like the housing situation. But it doesn't have to be this extreme scenario like the case X scenario you were talking about in Canada itself for it to just be ignored under the category of tail risks. In Canada, for example, after the rate hikes during COVID, after the inflationary episode after COVID, they raised rates from 0.2% up until 5%. So, and a lot of people went into mortgages. They bought houses when interest rates were really low, and their mortgage payments went to, in some cases, 70%. In some other cases, the lowest part is around 45-50%. So that figure was before was standing at 25-30%. So it ate away a lot of their disposable income margins that were going into consumption.
Is this
So
because
it
there are a
doesn't
lot
have to
of
be.
sorry to interrupt you, but is this because there are a lot of flexible mortgages in Canada? Is that why?
Yeah, 1/3 of the mortgages in Canada are variable rate.
Wow.
The other 2/3 are fixed rate. But even the fixed rates in Canada do get adjusted after 5 years.
Okay. Wow.
And a huge problem that they're facing is that in the coming year and 2 years, around 60% of all mortgages are going to be adjusted. And most of them are going to be adjusted up, even though they're cutting rates now. So that will continue eating away their margins and disposable incomes that can go into consumption. So yes, this is what I mean when we say that a case B scenario can be considered without putting this housing market situation into a case X, a bubble scenario, which is also very material. We can talk about that as well.
Yeah. So okay, but you mentioned what are interest rates at right now? Like you mentioned 5% at the peak. What is it now?
In Canada, they cut interest rates, if I'm not mistaken, 2 times, almost 2 times. So, if I'm not mistaken, it stands at around, just it stands around at 3.25 today.
Okay. Yeah.
Yeah, so it was at 5%, but they started their expansionary cycle. It stands around 3.25 today.
Yeah, and so the expectation is for that to remain roughly the same. But you mentioned the importance of the U.S., specifically tariffs and interest rates in the U.S. Now, Jared already mentioned that if tariffs are increasing, that has some sort of inflationary impulse in the U.S., so could contribute to them raising interest rates. Then tariffs also have that same impulse in Canada. So if this trade war continues, is that part of the hawkish scenario?
Yes, it is. Any type of tariff, any situation when it comes to the tariffs, retaliatory or not, even expanded to other countries around the world or not, would be inflationary, stagflationary. Canada announced 2 phases of tariffs. One of them are applied already. And in this case, they're not really inflationary because they do much have to deal with, let's say, beverages, clothing, those kinds of items that do have alternatives in Canada. So, and we're seeing consumers actually rushing into buying some of those types of items because if you look at the latest inflation figures and the breakdown of the inflation figures, they are mostly to do with in February compared to January, they're mostly driven with increases of inflation in these categories: alcohol, products, beverages, clothing, housing, equipment, those kinds of stuff that the sanctions have to do. But the second phase of the tariffs, tariffs that they're going to apply have much more to do with other types of products that they themselves do not have alternatives and substitutes in Canada and elsewhere as well, because Canada did not manage to divert away from the United States when it comes to trade. Even the first Trump presidency, when they had some trade tensions with the United States, and Canada was talking about diversification, but they didn't do anything. They couldn't diversify away. And it does speak to the fact that the pulling power, the gravitational pull of the US is too big.
Yeah.
Even if you look at some other countries that are more aligned with the West, let's say Japan, they mostly trade with China. They don't trade with the West.
Yeah.
So it's much harder said than done to diversify away from the United States when it comes to trade.
Yeah.
So it's going to be inflationary, and it's very much part of the case A type considerations, inflationary scenarios.
And what would be part of the case B? So dovish scenario, lowering interest rates because inflation is lower than expected?
Yeah. One of the things is very similar to what Jared said in the US. So this tariffs story can very easily be turned into a case B scenario where if trade wars continue and intensify, it can really damage economic activity globally. And the Canadian competitiveness in the US can really take a hit, and their exports suffer a lot. And if global activity diminishes a lot, it can transmit into case B scenario in Canada through oil and commodity prices, which are some of the stuff that Canada exports a lot of. That's one important consideration. And the housing situation in Canada is also another thing that can really turn it into a case B or more extreme cases of case B, where if property prices start going down and a bubble pops in Canada, that can really cause confidence issues, consumption confidence issues, and also investment in Canada, which can exacerbate whatever weaknesses they had that I talked about before.
Yeah. Okay, that makes sense. Okay, let's hop across to the other side of the pond, where we have another big ally of the United States that may find itself in trouble. Hayk, what's the situation like in the UK for the Bank of England? What are their considerations today, and then how does that translate into possible case A and B scenario?
Thanks. I think when we are talking about the United Kingdom and the Bank of England, the situation is rather different, and I will mention why. Well, the thing is that in this tariff war, they seem to be a bit distant. I mean, there are the tariffs on the steel and aluminium, and those are just less than 5% of the UK's exports to the United States, and they haven't retaliated yet, so they have a hope of having some negotiations with the US. And I think there is also the discussion of going into freight trade area, which would eliminate all tariffs. So the case of UK is really different, but I think they have their own issues, which makes the policy path ahead for the United Kingdom rather uncertain. And the thing is that, again, with case A and case B scenarios, it's what we've been seeing in other economies, the same type of shocks in the past 5 years. The UK was also part of it. We had still high domestic inflation in the economy, higher than the target. They seem to be struggled to bring inflation, especially the sticky prices, back to the target, and there's still weak growth, which is also because of a shock that was the Brexit, right? That seems to be kind of taking away their productivity potential. But I think you raised the question about stagflationary risks and what would Bank of England or any country's central bank responsible be to that. And maybe we could just have some parallels on this matter to understand the situation in the UK. Because there was also the Bernanke report that came up with some recommendations on what should the Bank of England do in order to improve their decision making, right? And you mentioned about stagflation risk and the policy stance. And I think here it's really crucial to understand the credibility of a central bank. Because depending on where you are on your credibility level, the turn of events that will determine your economic situation is going to be different. If you're in a low credibility system, which we've been seeing the credibility in the Bank of England kind of to fade away in the recent years, and this was also shown in their survey of satisfaction by the public. And if you're in a low credibility period or even a bit damaged credibility period, then the exchange rate, which is really important for an open economy like the UK, and the interest rate, they play as a stabilizer if you're in a high credibility scenario, right? So they kind of do their job, they absorb the shocks, and then the monetary policy plays its role, and we have inflation and output stabilization, without significant economic costs. But when you are in a low credibility system, which might be somehow the case for the Bank of England, given the recent policy missteps taken not only by the Bank of England but also other major central banks, right? This is also about the 2021, 2022 when they all relied heavily on baseline assumptions about inflation being rather transitory and kind of avoided giving forward guidance on different scenarios for the future of economies, and also coming up with an endogenous exchange rate path given their actions, especially for the UK. It kind of creates a situation where your exchange rate and your interest rates are rather shock amplifiers. And so UK seems to be struggling with this a bit, I would say, at this point, because while other economies are already kind of over the shocks that we've been talking, and Jared also mentioned in the past 5 years, the economy there still seems to be stuck in this, right? So this inflation de-anchoring and this inflation premiums embodied in sticky wages and inflation do not seem to fade away. And so the credibility is much of an important issue. And I think one of the reasons why we have more uncertainty about the UK's policy path and also their ability to decrease policy rates, even if they avoid any trade wars with the United States or let's say the rest of the world, seems a bit, probably less visible, less certain at this stage, because they still need to kind of incur some economic costs. And this economic cost is, of course, in terms of restricting consumption or growth by keeping policy rates high in order to show the public and the businesses that you are committed to your inflation target. And I think here when we come to the Bernanke report, that kind of sets the way for the Bank of England to have a way forward. And basically, let me just summarize the report, and then I can see why we talked about all of these issues before building a case A and case B scenarios. Well, Bernanke's report was actually just about the forecasting system and the monetary policy decision-making system for the Bank of England, which kind of set out rule that they need to take in order to improve their decision-making. And those are stuff related to better communication, scenario analysis, policy path, and exchange rate path forward, and that are endogenous. And by endogenous, we mean, we need to have scenarios, and for each scenarios, we need to have a policy rate path, we need to have exchange rate path that are consistent with these scenarios, and that we are showing the public that no matter which risks materializes, we have a plan, and this will be our reaction. So you are kind of trying to nudge the markets and show them your perspective, even though we know that, any of these scenarios could be just totally wrong. But the idea here is more like you telling your readiness, your commitment towards bringing inflation back to its target at any cost. Because as Larry Summers described in, I think, 2022, is, because these policymakers were rather trying to be reactive than proactive, the cost of delayed response was higher than the cost of over-tightening could have been. So in case of the United Kingdom, we still have the same type of case A scenario that my colleagues mentioned. And of course, there it's more about, the domestic conditions as the inflation and the sticky prices are still not back to the target. And given that there could be issues with the credibility, then the Bank of England might need to take a bit aggressive actions to restore this credibility, which necessarily means higher interest rate going forward, a bit, or at least, higher for longer. And then when we're talking about the case B scenario, I think it's rather a typical case B, given that we've been seeing weak fundamentals driven by this productivity gap and labor shortages that was also exacerbated after Brexit. So there is still the risk that, this weak consumer confidence, business confidence, this all risk could materialize further and kind of create a weak growth, like all this weak growth to remain further in the United Kingdom. But yeah, at this stage, I would say the risks are more about, the policy actions and the policy commitments on which spectrum they are going to be. And if we have the time, I don't know, maybe we could just do some parallels with, for example, another central bank like the Reserve Bank of New Zealand. That was kind of a good example of how you can gain credibility, and this credibility moving forward is making things way easier for you, because then you have an exchange rate that's just a shock absorber. Because back in the 90s and I think also the 70s and 80s, New Zealand had quite high inflation, and there were promises from the government to keep inflation low, but meanwhile there was massive government spending, and so it was impossible to bring inflation back to the target, especially when the monetary policy was expansionary. And I think after they they just gained their independence, and they adopted their policy forecasting system, and they started to publish policy path ahead and become more transparent and kind of started to nudge the markets. We saw that for New Zealand, at least, this inflation stabilization and output trade-off has been easier to manage.
Yeah, okay.
And so this was rather the main idea of having a central bank that has been committed for these kind of things for the past 20 or 30 years.
Yeah, okay, so what makes the UK a bit different from Canada and the US is you're saying like they have less credibility, and so inflation expectations are, as central banks would say, not as anchored as in Canada and the US, and so they would need to take more drastic actions than if that were the case. One question that I did have is like, what's inflation like now in the UK, and what are interest rates? What's the baseline scenario for the Bank of England that they themselves have?
Well, the external shocks have faded away from the inflation outlook, rather. So now there is only the domestic inflation component, and I think it's around 3%, a bit more or less. And then the policy rate is around 4.5%. So at its peak, it was 5.25%, right? And and again, it's really, when we're looking at some of the analysis about the policy rate path, the markets are anticipating 3 rate cuts from Bank of England. Mm-hmm. But I think if you're looking at how the decisions are made, we are still a bit uncertain, because those who were hawkish before from Bank of England's board, they seem to be more dovish now, so they are more in support of cutting rates at a higher pace. And so this makes a bit things really uncertain. So you don't really understand what is the commitment moving forward. And this was actually the problem that we were talking about, having an endogenous exchange rate path that is consistent with your economic narratives. But yeah, overall, I think the outlook is rather that.
So okay, we don't know precisely why they're turning more dovish, but you also mentioned in the dovish scenario something that I didn't quite understand. You mentioned labor shortages there. I can see how that leads to sort of lower economic growth, but isn't that also supposed to be inflationary?
Yeah, from that point, it's definitely going on the KSA inflationary side of story. But yeah, more from the economic fundamentals and the ability to kind of regain the momentum of growth, especially after exiting the European Union. It seems to be quite difficult, and I think in a case B scenario, it will be more about the consumer demand and the consumer confidence going down, and then not managing to regain the momentum of growth. But the labor shortages part is totally on the inflationary spectrum.
Yeah. Okay. Great. Thanks. So, okay, now I think we've gone over the sort of normal scenarios. Let's explore maybe what can really go wrong. Jared, let's just go back to where it all started. How is your case X or case Y, whichever you want to call it, scenario for the US?
Yeah, so we typically have these case X and case Ys for extreme scenarios. But what we've kind of noticed over the past couple of months is that these extreme scenarios, you can actually make a fairly plausible case for them. Even we mentioned before the fact that equity prices have already corrected by 10% from their peak, and that is almost entirely driven by the policy uncertainty of the Trump administration. So uncertainty is really high right now. And investors, consumers, both are, kind of handicapped by the uncertainty, and so that's, they're inclined to reduce their activity. And so under those types of situations, whether if, equity prices could continue to correct, and you could easily see 20%, 30% correction, if, the trade war were to take off, which is, almost unanimously considered as a deadweight loss for the economy. And then once that gets priced into people's growth expectations, then yes, a correction in asset prices makes complete sense. And if it's large enough, then that will easily weigh on consumer investor sentiment and behavior.
So a big crisis
we would have
is more plausible.
Huge, and we would have a real recession. So the what did people call it? It's people have been calling a recession, for many years now. It's the most anticipated recession that hasn't happened, right?
Yeah.
And so we may finally get it if this were to continue and metastasize into something bigger.
Yeah, and the Trump administration itself is also more and more sort of talking about it, right? In the sense that they're talking about, no pain, no gain, something like that. Whereas previously it was sort of understood that Trump wanted the stock market to go up, and they called it there's a Trump put. He will always intervene. And now I think he even himself has said, if stock markets will go down, they will go down. We have more important things. We want to reindustrialize the United States by lowering the dollar and tariffing the living daylight out of our friends and foes.
Yeah, that was actually a very big conceptual change in how to view the Trump administration. We thought that the Trump put, meaning they would try to push as much as their agenda forward. But the moment that you would see, and I would, 2 months ago, if I would have expected a 10% correction, there would have been a major reversal in their talking points. But we're seeing the complete opposite. So that's suggestive that, yes, they understand that the correction happened, and they're actually okay with it. In a certain sense, and that it's not going to stop the agenda going forward.
And Koko, if we have a big correction in the U.S. in equity markets, like a financial crisis there, maybe even, how vulnerable would Canada be?
They naturally would be very vulnerable, but their issues lie in the housing market. If we're talking about extreme scenarios, that's the main point of vulnerability for them. And I want to also mention that you compared the UK as being non-credible or having less credibility to Canada and the US. Canada had the same problem relative to the US. If you look at inflation now in Canada, they've had also going into COVID less credibility stock, if we can call it that. Just the same things that Hayk mentioned, they were present in Canada as well to a lesser extent. They don't also have an endogenous exchange rate and interest rate paths for different kinds of cases.
Yeah.
But the main point
do you also think that the exchange rate can then act as sort of an amplifier rather than a buffer if something goes wrong, similar to what Hayk said?
Yes, I do.
Okay.
That's not specific to any country. It would definitely be the case for Canada as well.
Okay, thank you. Hayk, over to the UK. You did mention that their economy is a bit different. They are also perhaps less hit by the tariffs right now. They're more integrated with Europe rather than America, at least compared to Canada. In Europe, perhaps we're actually seeing some defense spending boom. Could there also be, is there less risk of a major crisis scenario in the UK, or not really?
Yeah, probably again I would connect it with what you mentioned as the exchange rate, the risk of the exchange rate transmission happening in the UK. Maybe the risks are more. Maybe just to make my point easy, we could compare it to the case of Israel just quickly. Like I think back in early 2000s, Israel had two kind of inflationary shocks. The first one was, just shocks in terms of monetary policy. And the first one was after the dot-com bubble. Right after that, the growth was weak. So the Bank of Israel was kind of bringing the rates down to support the economy. And this was further weakening the exchange rate. And back then, they had lower credibility. So what we saw happening was that in this situation, when they had lower credibility, they just amplified the effect stemming from exchange rate into more inflation into the economy. Right? Because usually you do afford to decrease your interest rates during such periods if you're more advanced economy, like the US. And but in those kind of economies where especially you have issues with credibility, decreasing rates while those things are happening could affect more when the exchange rate transmission channel is stronger. And then we saw after that, they kept the interest rates higher for longer, for a long time. And this definitely hurt the economy and create major costs. And then they kind of restored the credibility. And then when in 2006, some inflationary shocks hit the economy, the monetary policy only took modest steps. So again, the problem was that, they restored credibility. So the exchange rate channel wasn't posing as much of an issue. So maybe now what I'm thinking, like a worst case scenario, if we have it in the UK, would be that even though if you decide to increase the interest rates to some point to kind of defend even your currency, this could even again translate into depreciation when you have a risk premium in your economy, right? And this was also the case in Israel. When they started to increase the interest rates after decreasing them for a while, we were expecting that, the exchange rate would appreciate, but the opposite happened. They just created more risk premium, so the markets were not really understanding what's going on. So by increasing interest rates, it kind of made the situation worse. So again, we are coming to the why it's really important to have more scenario analysis and then provide an exchange rate path for each scenario so you can avoid any speculative attacks. Maybe just like this.
Very interesting. And what's really interesting to me, and I don't know if you guys know this, but the Treasury Secretary, Scott Bessent, was sort of part of the team from George Soros, as known as the man who broke the Bank of England. And I find it quite ironic that now Scott Bessent might again be the one who will break the Bank of England, at least Hayk, if they don't get their credibility up. Let's end it on that. Thank you all so much for these scenarios. I think it's very interesting, extremely interesting times. And I think next week we'll talk about some more central banks and see what's going on then. Thank you so much, all of you.
Thank you as well, everyone.
Thank you.
Thank you.